Well, there goes the bell to usher in a new program for the year 2017. This is the Trading Bell. We are coming to you from the Nairobi Securities Exchange. My name is O'Brien Kimani, and this week we focus on how the market has performed. And of course, we look at the sentiments that are likely to shape the market in the year 2017. I'll be joined later on by Edwin Chui. He's a research analyst at Dyer & Blair. But for now, we join Chief Executive Officer of I&M Bank. This is Kihara, Maina. And I'll be wanting to find out where is the bank going in the year 2017. Thank you very much, Kihara, for joining us.
Thank you very much for having me.
Please, take position. Well, I mean, as a bank, you've been around for almost 50 years now, since 1974. You have been in the banking industry for close to 25 years. That's almost a quarter of a century. It's quite a long time. When you look at the banking industry, back then and now, what conclusions do you make?
Well, we have certainly come a long way. I think if you consider the way the markets have evolved, you'll recall that back in the day you had controlled markets. We've sort of gone back somewhat to that space in some respects, but there was a lot more direction then in terms of what you could and couldn't do. And the freeing up of the markets then led to a lot more innovation, a lot more growth, and I think has played a significant role in making sure that the country sees the level of development that we have seen so far.
And it's some with the coming into effect of legislations to control the cost of credit, it's somehow like we're going back to the past. Do you think this is good for a market like ours?
I think we have to look to the reasons why we saw that reversal. And I think to appreciate that there are important lessons that banks have taken from this action. And to also understand that there are certain actions that need to be taken to really make sure that this is a beneficial move for everyone. Well, I would say that we need to appreciate that what translates into the cost of banking isn't just simply, the prices that banks are charging and the margins that accompany that. It's also the inputs that go into that, and a lot of them are a reflection of what the costs of doing business are as a bank. So we have to address all of these things holistically, and rather than just simply look at, well, let's take it out and address this using a somewhat blunt instrument by just capping rates. I think we need to look at it and say, how do we actually make market forces work very effectively? Let's make sure that we are translating the competitive forces into benefits for all Kenyans.
Of course, the Act came into force sometimes in October, so we are yet to get the official figures on how it has impacted the market from the Central Bank of Kenya. But for you as a bank and being an insider, how has this impacted your business?
So as you said, it's actually still relatively early in terms of the teasing out the impacts. And I think despite the start in late September, what we have seen obviously is an adjustment period. A lot of things had been sort of held back as people waited to see exactly what would happen. The implementation process hasn't been exactly smooth. There was quite a lot of uncertainty around exactly how to go about effecting this. And throughout all this, banks were trying to do the right thing and make sure that they comply with the law and make sure that they also don't hurt customers. Now, still early days to tell, but already you can see adjustments that are being made in terms of whether you are destroying any value for your shareholders by taking actions without really saying, how do we adjust our business models? So there's a lot of thinking that's going into the recalibration of business models, as you can imagine, across the banking industry.
As a bank, how have you managed to deal with this new regime?
Well, the good thing is that we had already started from a point where we had a very efficient operation. So we were able to say, well, okay, how do we adjust to this without impacting our customers adversely? I'm pleased to say, obviously, we effected it for all our customers, but what we have been able to really do is have conversations with our clients so that they can understand exactly what this means in terms of impact to us, and also how we can work together to really get an outcome that is favorable to them. At the root of it is really making sure you have good relationships with your customers, and then even as you adjust and tighten your belts to adjust to this, how do you do this and make sure you have good outcomes for your shareholders, for your customers, for your staff? Mm-hmm. That's really what we're focusing on.
And in terms of credit advances, have you settled? Have you gone up? Have you dropped?
It's been a relatively difficult year, I'd say, for the banking sector in terms of credit. So you will notice that actually we've had very low growth in the private sector credit. And that is symptomatic of a wider challenge, I guess, in the markets. So we haven't been immune to that. We've seen relatively muted growth in terms of our asset book, and we haven't seen any real change in that in very recent times. We still have the same discussions we're having with our clients about how we can help them with growth. We haven't been as adversely impacted in terms of certain demographics because we were not really active in those demographics. But in the corporate space where we are predominantly present, we have continued to see the same kind of growth that you would expect given the conditions that we have.
Mm-hmm. And when you're talking about flat growth, what kind of growth are you talking about?
Well, we've been seeing less than 10% overall. I mean, if you talk about credit expansion, you've only been talking about 4% so far this year for the country. Mm-hmm. So, but you will still see, as you look at the balance sheets of banks, year on year you're getting closer to 10% growth, mm-hmm. but maybe not as much as you would have liked to see. But as I said, it is symptomatic of the performance of the economy generally.
Mm-hmm. So when you're having a situation whereby credit is plateauing, how is this then likely to impact on your profit, bearing in mind that a significant portion of your profit comes from income interest?
Well, this is where now innovation has to come to the fore, because I think the focus has to be on what other things do you do as a financial services provider. Mm-hmm. Because clearly with a shock like you saw with the interest rate capping, it shows that you're vulnerable to interest rate income being impacted in this manner. So diversification of your income streams is important, and that's what we've been trying to do over the past few years. Mm-hmm. We have ventured into bank assurance, which is doing well. We are offering advisory services. We recently acquired Babbage Capital, so it's now operating as I&M Babbage Capital. Mm-hmm. That is going to strengthen our linkages in the corporate sector, make sure that we can also provide under one roof the range of services that our clients require. Mm-hmm. And really focusing on our service-led income, mm-hmm. really to just say, we appreciate that what clients are looking for is mm-hmm. quality service. Mm-hmm. And if we strengthen that, then we would expect that our fee income would also help, balance out that mix of income.
Mm-hmm. Being a tier 2, lender, the last 6 years or so, I mean, you have been on a spending spree, acquiring stakes in different entities, from Babbage Capital to Kihara Bank. How has this augured for you as a bank?
Well, I think it is evident that we are keen to really make sure that we can build a financial services business that spans the range of services that clients are looking for. And it's not advised by just wanting to get bigger. It's actually about completing a set or suite of services that we feel are complementary and that can be brought to bear for our customers. Now, obviously, this is also accompanied by, as a group, looking at our geographical presence. So we appreciate that our customers want to do business increasingly in geographies outside Kenya. And we are saying, well, we want to be able to serve them across all those different geographies. So it's both from a product suite perspective as well as from a geographical perspective that we are looking at our inorganic growth.
And as we wind up, because we have to come to an end, you operate in Mauritius, Kenya, Rwanda, Tanzania, and Uganda. And I know that business has been very tough, especially in Rwanda. When do you expect to break even in these markets?
So to be clear, we are not in Uganda yet. It is certainly a picture we want to complete. But in each of these businesses, we are actually profitable, right? And we have been in some of these markets for actually quite a while. But even the recent ones are already very well run and making a lot of good returns for us. So we think that it is something that we will expect to continue growing. We have continued indeed to invest in them, additional capital in some of the businesses, as we look to finance the growth that they are considering.
And finally, as we come to the end, I want to find out from you, we have seen your operating expenses grow to the current levels of 7.4% from 5.1% 3 years back. Is this worrying you?
No, I think I appreciate that as we grow, we are going to see growth in our operating expenses. I think what would worry me is if our income is not growing commensurately, because we expect that if we are running efficiently, then we should see that all our shillings are actually that we are spending on cost are actually giving us the returns that we expect. So as long as it is clear that we are not being wasteful, then that is fine.
Good. Yeah. Thank you very much.
Thank you very much
for joining us here.
Okay.
Kihara Maina is the Chief Executive Officer of I&M Bank, joining us here on the Trading Bell to help us understand the banking market dynamics. This is the Trading Bell. Stay right here. There you are, the figures there with the market moving about 20 points up to this point. Edwin Chui is a senior research analyst at Dye & Blair, joining us here so that he can help us understand these figures and of course get to understand where is the market going in 2017. Thank you very, very much indeed, Chui, for joining us here. 2017, a very critical year for the country. We are going to the elections. Donald Trump is going to be sworn in a couple of days from now. What do you see in the pipeline?
Well, we actually have a lot of uncertainty in the market right now. There's the issue of the election. We do not really know what's likely to happen, although I believe everything is going to be okay. And then we have the Trump presidency coming on, and he's promising to pursue very pro-growth policies in the U.S., which will most likely make the dollar much stronger than it is, which could affect the shilling. And then we have the decision by OPEC to cut supply, which means the price of oil may go back up. And that again may also have extra pressure on the shilling. So we do have a lot of moving parts, including Brexit starting formally in March. But I think we have a very resilient economy, as we have seen in the last 2 years. So we should expect things to either stay the same or improve.
I mean, you have mentioned a couple of, or a cocktail of external vis-a-vis internal factors.
Yeah.
When you scan the horizon,
Yes.
between external factors and internal factors, which one do you think are likely to influence the market even more?
I think external factors are likely to influence the market even more, mainly because our market is dominated by foreign investors. So if you look at the performance last year, 71% of the net buying was done by foreign investors. Yeah. And these are people who have in the past maybe considered lower yields in the US as a reason why to come here, or a weaker dollar in the US as a reason why to come here. But now they are most likely going to face a scenario where the dollar is much stronger, where it maybe makes sense to put the investments towards dollar-denominated assets. And then they are also maybe going to be looking at a situation where they cannot be sure what's going to happen in our election.
Yeah, sorry. And the market is still in a bear mode.
Yes.
Do you see this trend persisting?
Not necessarily. I think there are things that we can do locally here to make the market come back up. For example, I think there are steps that the government could, for instance, take to make sure that the market comes back up. And the reason why I say that is because we do have, pockets of institutional investors in here who are capable of driving the market back up. Who have maybe shied away from our market even when foreign investors are actually coming. It's one of the sort of ironical aspects of our market where external people have more confidence in what you're doing than yourselves. So we don't have to be in a bear run. There are steps the government could take. There could be more privatization. There could be more incentives thrown towards local market players to make sure they come into the market. Yes.
And when you talk about privatization, I mean, we have been talking about the selling of public-owned sugar companies like Sony Sugar, Chevron, and this.
Yes.
Are you confident? So do you see this happening this year in order to rev up the market?
It's unlikely that it will happen this year because of the political implications, but I think it's something that is definitely going to happen at some point, especially because the evidence speaks for itself. When you look at all the companies that are underperforming, when you look at all the entities that are underperforming, there is an enormous connection to public ownership, government ownership, I mean. And it seems we sort of have to get to a point where we privatize maybe not everything, but a bit of them to be able to kind of drive the change that is needed. So I think it's something that we know, and it's something that we are going to get into as soon as possible. And
I want also to find out from you, what would you advise the investors out there? Is this the time to buy? Should this be the time to sell?
It's very much the time to buy. And when you think of it, when you go into the stock market, you're often going with a long-term perspective. So let's say 1 to 3 year perspective. And there are so many things that are so discounted right now that 2 to 3 years right now, you're definitely going to be in the money, even if the market falls a bit lower than it is right now. And I highlight, it's a bit important to look, there's been the bear run that was there, and then there was a rate curve that pushed financial stocks further down, the banks further down. And all that is going to sort of change because all this is cyclical. We have a moment when everything is down, like now, and then we have a moment when everything comes back up. And I think that moment is way post due. So I would definitely encourage people to buy in right now, even if they are sort of concerned about the possible volatility in some stocks. There are those stocks that are like by nature defensive. Whatever happens, they will do well. East African breweries, for example, whatever happens, whether the economy is bad, people consume the product, which means the stock performs well. The same thing applies to BAT. And when you think of it, the same thing seems to apply to Kengen because we are in a period where we need to keep generating energy non-stop. And the risk in energy is more in Kenya Power than in Kengen. So Kengen can generate as much and just sell it off to Kenya Power. So there are those stocks that even if you're not too sure what's going to happen, you can go into because they are perfectly stable and resilient.
These are the kind of markets where the kind of shares where you can bet your grandmother's court.
Yes, absolutely.
Very well. Tell me this. When I look at these figures, I'm somehow gobsmacked by these factors. Kengen, moving 93.7 million shares. Safaricom, 12 million shares. What is happening with Kengen?
Kengen, as I just mentioned, it's a defensive stock. When you are an institutional investor looking to pick a position and you are not sure where the banks are going to go or where Centum is going to go or these other companies are going to go, you can be sure that in the period that we are in, Kengen is going to continue making revenue. And as you've seen, the price is too low, it's too discounted to encourage investment for people with a long-term perspective, just maybe two to 3 years perspective. So it does make sense to me that you're seeing Kengen performing extremely well in terms of volumes traded. Yeah.
And what about Britam? We have also seen Britam making some serious moves in there.
So we had this material information to the extent that IFC is going to be coming on board, taking a 10.3% stake of Britam for about 3.5 billion. And the critical information was that they are paying a premium to the market price at about 15 shillings. So that means retail people were inclined to buy the stock because they expected the price to go up. Now, the only issue with that is that it was privately placed, so it didn't sort of cross through the market. Good. But the beauty of it is that IFC has a track record, and everyone can expect that their entry into Britam is only going to make things much better. So
that is somehow swaying the performance of, the share.
Yes.
Edwin, thank you very much indeed for your time and for your information.
Welcome.
Edwin Chui, Senior Analyst at Dyer and Blair, joining us here to help us understand where the market is going. The Market 101 is coming up next. Stay right here.
My question is, when an investor wants to invest, what should he or she look into investing when coming to the Nairobi Securities Exchange?
As an investor looking to buy shares, you should consider the following factors. Number one, is the stock trading at a discount to its value? And if it is, it means the price is going to rise at some point. Number two, does the company pay dividends? If it pays dividends, then it means you're going to have more cash flow from the investment other than the value of the share itself. The other thing you can consider is how long you intend to make the investment. If you're short term, then you want to look at stocks that tend to move up and down over a short period of time. And if you're long term, then you want to look at stocks that have made investments over a long period of time. And lastly, it may help to look at management, the nature of management, the performance in the last couple of years, the issues involved in the company, just to be sure that your investment is going to be safe.
Well, getting in touch with our history there on historical fact. Remember that time when the market was actually a market? Well, at this point, we come to the end of Trading Bell for this week. And of course, This has been the first edition of Trading Bell for the year 2017. We look forward for much of your engagement. And of course, remember, you can always get to us. Our Twitter handle is @TheTradingBell. Our SMS line is 22162. And remember to start with the word BIZ, that is B-I-Z. Well, Facebook page is The Trading Bell TV show. My personal Twitter handle is @O'Brien Kimani. Thank you very much. We look forward to see you again next week right here on KBC Channel 1. Back to you, Broadcasting House.